Welcome back to another episode of Investing Explained. Here's today's question.
My response would be yes, I do follow a checklist, but mine's not actually written on a piece of paper that I literally go line by line, kind of like computer code, but I have a process. A lot of the process that I use can be seen if you check out any of the articles that I write on Forbes. The methodology that I use for every time I do an intrinsic value assessment for a company is the methodology that I use and the thought process that I use as I step through. I always start off trying to understand holistically, what does the business do? I go through that analysis. I see, how much do they do in sales, just to kind of give myself a general idea of what the business is. If I feel like the business has been filtered based off of enterprise value to EBIT at a good return, okay, I'm using that as a filtering tool. I then go in and I calculate the intrinsic value based off of a discount cash flow analysis. And Stig and I talk a lot about that. We have videos and all that kind of stuff on how we do that. But then I figure out what I think that the return is going to be as a percentage. I'm basically calculating the IRR of the business. And then I compare that IRR to every other investment opportunity that's out there on the public markets. And then I compare that to how I would invest that money operationally into the business that I own. And if I could get a better return comparable to the risk. And so that's really where I step into the comparative analysis of the return to other returns that I could get in the market. So let me give you an example. Let's say that I just did the intrinsic value for a business and I calculated it at 8%. And then I compare that to the S&P 500, which I think is giving you 3% or less today, compared to the 10-year Treasury, which is also around 3%. And so I'm comparing it to all these other different asset classes. Now, let me give you an example. Let's say that I just calculated the intrinsic value of a business and it was 3%. And I can go to the S&P 500 and get 3%. I am obviously going to pick the S&P 500 over the individual stock pick because I'm getting the same exact return, but I'm assuming a lot more risk by owning the individual company. Now, the growth rate could potentially impact, if I have an expectation that the growth rate is going to drastically increase in the future, maybe that could impact it. But for the most part, generally speaking, that's how I look at that. So after I do that, then what I'm doing is I go through an analysis of looking at the competitive advantage of the underlying assets of the business. Business schools will tell you that your risk is the volatility of the past performance of the stock, which I think is absolutely ludicrous, and so do a lot of other billionaires that we study. Your real risk in owning a business is the ability of the underlying assets, especially the assets that are bringing in all the revenues that are profitable. The impairment of those assets is your real risk. So let me just explain this in simple terms. So if you own a coffee shop on Main Street and there's a vacant building right across the street, and there's somebody in the business of trying to open up another competitive coffee shop right across from you, the endurance of your competitive advantage of your coffee is at stake. Your assets could be impaired. That's how you got to look at the impairment of the underlying assets, because that's where your real risk is. So then what I do is I look across. So let's say that the first check mark of looking, or basically the second check mark of looking at the intrinsic value of the business, and I say this has a high yield, I'm very interested in this company. But then I get to the second step in my checklist, which is understanding the impairment of the underlying assets, and I find that they could be greatly impaired. I might discount the return that I'm expected to get on that company. I make adjustments to what I think that return is based off of the ability of the company's assets to be impaired. I then also consider at the very end, I look at the macro factors. So where are we at in the economy today? How do I expect the economy to perform moving forward from a global sense? I basically look at the momentum of the overall market, and I also look at the momentum of the individual company and what that price action looks like. And then I basically make my final decision on whether I'm going to own it or not. Those are the main variables that I'm looking at as I go through the process. I would like to tell you that I do it in a linear manner in the same order every time. And maybe that's, to be honest with you, maybe that's a disadvantage with the way that I do things, that I don't do it in a sequenced, ordered way. But for me, I guess I'm trying to look at things more holistically, but I always cover all of those bases as I'm going through an individual stock pick. So yes, I have a checklist. I hit all that, but I don't necessarily do it in a sequential order.
Just really a quick note to what you said, and especially for people listening to this and say, wow, that's a ton of steps, and how to best illustrate this. We have a completely free resource on TAP Academy. It's our Intrinsic Value Index, and I think we have around 40 or 50 picks, and where we use this process that you talk about, Preston. We'll make sure to link to that in the show notes. Of course, people can also sign up to our email list where Preston and I would send out these picks on a monthly basis. So yes, I also use a checklist, and if I could just highlight a few of them and provide some comments to that. One of the first things I look at, that is revenue, and I know that Preston also briefly mentioned that. If I could just add one more thing to that, I'm looking at if there's any revenue decline in the core business. One thing is that you might be looking at revenue, just see, well, that's going up. Yes, but what is the core business? And do you see a revenue decline there? What you see a lot of companies do is that they would acquire a lot of new companies to sustain revenue growth. That does not always make a lot of sense to all companies. Sometimes it's a short-term win for a long-term pain. Of course, unless you have a company like Berkshire Hathaway, it is their forte to add new businesses to their existing business and thereby grow the revenue. It is different for most businesses. So that's something I look at. I look at declining margins, and I look at debt. And specifically about debt, and one thing I would like to highlight, if you use a checklist, it's very important to control the checklist and not let it control you. And if I can just provide one example of that, is that I have this general rule that I would like the coverage ratio to be above 10, meaning that you can at least pay back your debt 10 times with your operating income. But it really depends. I mean, you can have interest coverage ratios that are at a comfortable level, but then whenever you look closer at how it's financed, and if it's not fixed, if it's variable, and if you learn that they will finance new acquisitions next year with more valuable debt, perhaps then you can't use that checklist to do many things. So I just wanted to put it out there in terms of, if you have a checklist, you can't just say, check, and then move on to the next one. You have to really understand what it is and then make the necessary provisions. And I know this might sound counterintuitive, because the point about a checklist is that these are your rules and you shouldn't deviate from your rules, because that's really when you're going to paint yourself into a corner. I do think I have the opposite view. I think it's very important that you control the checklist rather than the other way around. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.